Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for you in light of your financial condition.
Good morning. It's Tuesday, January 6th. I'm Phil Streible, Chief Market Strategist at Blue Line Futures. So will the rebalancing crush the gold and the silver market? That's the new narrative that people are hanging on. Back about a week ago, it was, will Chinese export restrictions crush the silver market? Will the rising margin requirements from the CME group protect the short sellers and decimate silver back down to $50? So we might as well throw rebalancing in the mix and keep the why alive rather than focusing on the signal here, which has key levels of support, resistance, looking at some of these things mechanically as far as where average true range is, where the signal would break down to a neutral trend, where things would break to a bearish trend on those markets. So getting back to the why here and addressing this rebalancing concerns. Many investment and advisory firms have already done the rebalancing towards the final 2 weeks of the calendar year. However, the question I keep getting is the assets tracking the Bloomberg Commodity Index, which total about $109 billion as of October, that product is set to rebalance. Now, passive investors are bracing for a notable shift in the commodity landscape as the Bloomberg Commodity Index prepares for its annual reweighting, which is coming soon. And a spotlight falls on some of those precious metals, specifically the gold market, where the allocation is set to drop to 14.9%. This comes after it recently rose up to 20% of a weighting of that particular fund. So passive funds that are tracking the index, the reduction in gold's allocation is likely to trigger mechanical selling of roughly $6 billion. Now here's where it's interesting, is the shift comes as if you look at the difference between 2025 and 2026, the reduction in gold here, they're actually looking at raising that target allocation on the gold market here. It's just the fact that the product got stretched too far within it and people need to rebalance. So roughly what we're going to see here is that it's got to comply with a rule that no single commodity can exceed 15% of its weightings in order to seek and maintain the diversification. So when the product grows to 20%, they've got to trim that down. And the same thing with silver here. What about silver? Well, silver could face some greater headwinds with the 2026 target for the metal set to 3.9%. What is the current weighting of the allocation of the portfolio right now? It sits at about 9.6%. So this all sounds scary. You got to take something from 20%, which represents $6 billion in mechanical selling, and bring it down to about 14.9. You've got the silver market, which sits at 9.6%. You've got to bring that down to 3.9%. Here's the reason why investors shouldn't panic, in my opinion, and it comes based on experience. I ran one of the largest trading desks at Lynn Waldock and MF Global, and I executed some of these rolls and reweightings before. And the index, what they do is they move these new weightings here gradually during a transition period that takes effect over a number of days during a month. We would roll the positions during some of the most liquid hours, and then we would trim positions systematically over a 3 to 5 day period with the objective of not disrupting the market, because that's where regulatory bodies come in and things like that. And if you're a fund, you're trying to avoid those types of things, the unnecessary scrutinies of disrupting the market. Now, the market has gotten much more liquid over the 25 years that I've been working in futures and commodities. So in my opinion, the rebalancing, yes, it's a narrative. Yes, they throw out a lot of scary numbers, but I do not believe that it will have a meaningful impact on the market. Now, looking at the broader picture, looking at those precious metals, gold up about $22, sitting at $44.74. You got silver up $1.56 at $78.24. Remember the Chinese export restrictions, the panic of the rebalancing, the panic of the margin requirements. These are all these things that people throw out here, and it's really to get clickbait and numbers and things like that, because many of the different people that put out content on social media and things like that are either newsletter salespeople or they're just trying to talk their particular position, and they are unregistered people. Now, looking at these markets here, you do see the platinum market up $51 at $23.35. You got palladium up $27 at $17.91. You got copper back at $6. Amazing move here yesterday in the copper market, bringing it back up to that area where Trump did make an announcement in May and copper prices fell about 33%. So we'll see if there is any kind of significant profit taking at these levels, or you get some volatility, or you get the potential for some of the discussions around those import-export restrictions, the tariffs on the metals and things like that. Now looking at the stock market here, we do have the S&P 500 just slightly negative, 69.39, down about 4 ticks. You got the NASDAQ up 20. There's a lot of talk about tech stocks here, different AI themes and stuff like that with a conference going on in Las Vegas. You got the Russell 2000, explosive move yesterday here, 25.55, down 7. You got the FANGs down 13 right now. No big standouts here across the board on any of the different markets. You see stocks in Asia, they surge. There are some growing concerns that they may be overbought, along with some of the gauges in Europe and the emerging markets and the macro and the geopolitical risks. They are numerous with Venezuela, Greenland, Thailand, Taiwan, all in the picture and in the headlines here today. There have been 4 years where the S&P 500 fell at least 15% before managing to climb back above 15% or more in the calendar year. And it happened in 1982, 2009, 2020, and when? 2025. So all these previous cases have been followed by strong gains the following year. So we will find out if 2026 will deliver a 4th straight year of double-digit returns. Now, in my opinion, you look at the way things are going, there's going to be a shakeup at the Fed. The current administration wants lower interest rates. GDP growth is rising. Inflation is falling. Look at the energy sector. Look at natural gas down 3%. Look at crude oil poking up to couldn't get over $60 a barrel. You've got all this nonsense going on, and it's unable to rally. If you look at crude oil over the course of 2025, continuously lower highs here on the chart. One blip with the US, Israel, Iran, where it got up to $80 a barrel, and the realization is that Iran is basically unable to shut down the Straits of Hormuz, so it looks to cap prices right there. And personally, I think that the focus after Venezuela, this Greenland thing, is going to be a regime change over in Iran as protests are really taken underway. Now, if you look at the rate cut expectations, we do have some economic data coming out. We got final December PMI readings due out. We've got Fed's Barkin scheduled to speak at an economic outlook forum here early in the morning. You look at the CME's Fed Watch tool, 16% likelihood that they cut rates at that January 28th meeting. We will want to look at the labor data coming out at the end of the week. If we see an uptick in the unemployment to 4.7%, we should see the expectations for the January interest rate cut go straight up. 10-year yields straight down, dollar index under some pressure, U.S. equities, kind of some volatility there, but the dip buyers look like they are remaining active. Now in the March 18th meeting, we'll see a 42% chance right now that they could potentially cut rates at that meeting. You look at the dollar index here, 98.14, key level resistance, 98.75. Look at the euro currency, 117.50, key level support, 17.09. 10-year treasury yields trapped in a range here. Throw up a chart, a daily chart of 10-year treasury yields. You can see from about 4.11% to about 4.22%. The yield curve has steepened recently, with the 2-year anchored and going a little bit lower on the short-term ones, and the 10-year, because of the growth that we're seeing in the economy, holding up quite strong, as well as the 30-year yield. You look at the VIX futures, 1649, not showing any panic in the market whatsoever. Bitcoin futures showing a risk-on environment here. We signaled that a potential move back over the 90,000, which occurred. Now an extension higher up to about 94,000. 94,400 is a key level where if it breaks and closes above that level, we could see a move on up to 100,000. You look at S&P 500 gamma exposure. Well, the dealers, they shifted back to neutral gamma here from that negative gamma. You go over to Europe and Asia, where we talked about, hey, these guys are potentially overbought, signaling a little bit of a mixed picture, but European stocks, they did edge higher, lifted by the miners after copper surged to a fresh record as investors bet on a tighter market. That's where that big move came in here yesterday. We do have Asian equities rising to a fresh record high with a rally in China, helping fuel those strong appetite in that region. So the MSCI Asia Index here at Pacific Index rising about 1.3%, posing its fourth straight day of gains. Then you look at the ETF flows here in the metals. Well, they bought some gold, they bought some palladium, they sold silver, and they sold platinum. So silver, from an ETF exposure, really hasn't gotten much love this year. So you go to gold, year-to-date percentage change down 0.1%. They added about 27,000 troy ounces of gold to their holdings here year-to-date here and as of the previous session. And then you look at silver, they cut about 0.4%. So total year-to-date down 0.4%. And the ETFs cut about 3.32 million ounces. The gold-silver ratio sits at 57-1. So the point on this is that really what I focus on, I'd say the scary thing about the silver market is going to be the average true range, because the average true range right now on silver is $4.38. That comes out, that's the 14-day average true range. That means on the 1,000-ounce contract, you're seeing about a $4,000 move back and forth like this. A lot of people with smaller accounts, they just can't stomach that, especially if it triggers a couple of days or it triggers the event what we saw 2 Sundays ago where it gets up to $82, a little bit above there, and then Monday morning we get this liquidation that occurs where you became the exit liquidity if you bought on those. You bought the Friday, the holiday, then you buy that Sunday breakout up to 82, and then you get washed out on that Monday sell-off in very thin trading environment. That's why you want to really be careful when you're trading in thinner type of environment here. Now we are back to the first full week of the trading year, so the liquidity is coming quite a bit. Yes, the volatility is still there, but the important thing to watch on that average true range is, has it peaked because of the thinner environment, and are we starting to come down from here? Because we'll get much more organized trading in the silver market, and it's the organized trading where those key levels of support, resistance, we get the premiums coming out of some of the option markets getting more normalized on there as some of the emotions die down because the volatility dies down with it. So if you guys got any questions, shoot an email to info@bluelinefutures.com. Remember that futures and options trading, it involves significant risk of loss. It may not be suitable to all investors. Good luck, good trading. Remember, I'm in your corner.
Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for you in light of your financial condition.